What if I told you that one of the simplest investing strategies in the world consistently beats the majority of professional fund managers? We're talking about index funds. And if you're not using them, you might be leaving serious money on the table. Today, we're breaking down exactly how index funds work, why they've become the go-to strategy for millions of Americans, and how you can start using them to build long-term wealth. Whether you have $50 or $50,000 to invest, this video is for you. Let's dive in. Let's start with the basics. An index fund is a type of investment fund designed to mirror the performance of a specific market index. The most famous example is the S&P 500. That's the index tracking the 500 largest publicly traded companies in America, from Apple and Microsoft to Johnson & Johnson and ExxonMobil. When you buy an S&P 500 index fund, you're essentially buying a tiny piece of all 500 of those companies in one single investment. There's no fund manager sitting in a corner office trying to pick winners and losers. The fund just automatically follows the index. Simple, elegant, and incredibly effective. Here's the thing. There are two main approaches to investing in the stock market. Active investing means you, or a professional fund manager, are hand-picking stocks, trying to beat the market. Passive investing, on the other hand, means you're simply matching the market by tracking an index. Now, active fund managers charge higher fees for their expertise, typically between 0.5% and 1.5% of your money every year. Index funds charge a fraction of that, sometimes as low as 0.03%. That might sound tiny, but over decades, those fee differences compound into tens of thousands of dollars. And here's the kicker. Despite those higher fees, the data consistently shows that most active managers fail to outperform the index over the long run. Let that number sink in. According to the S&P SPIVA scorecard, that's the industry's gold standard for measuring active fund performance, over a 15-year period, 92% of large-cap actively managed funds underperformed the S&P 500 index. Not 10%, not 50%, 92%. That means if you paid a fund manager to try to beat the market, odds are overwhelming that a simple, low-cost index fund would have served you better. This is why legendary investor Warren Buffett has repeatedly recommended low-cost S&P 500 index funds for the average American investor. The data doesn't lie. So, how does the mechanics actually work? When you invest in an S&P 500 index fund, the fund uses your money to buy shares of all 500 companies in the index. The amount invested in each company is weighted by market capitalization. That's the total value of a company's outstanding shares. So, a massive company like Apple, which has one of the largest market caps in the world, gets a bigger slice of the fund than a smaller company. As companies grow, shrink, or get added or removed from the index, the fund automatically rebalances to stay in sync. You can access index funds in two forms: traditional mutual funds or ETFs, exchange-traded funds, which trade on the stock exchange just like individual stocks. Let's look at the historical performance of the S&P 500. This chart shows how the index has grown over the past several decades. Yes, there are dips: the dot-com crash in 2000, the 2008 financial crisis, the COVID drop in 2020. But zoom out, and the long-term trend is unmistakably upward. Historically, the S&P 500 has returned approximately 10% per year on average before inflation, and about 7% after inflation. Past performance does not guarantee future results, but this long-term historical trend is exactly why index fund investing has become the cornerstone strategy for millions of American retirement accounts. The key word is time. The longer you stay invested, the more that long-term trend works in your favor. This chart illustrates one of the most important concepts in personal finance: the devastating long-term impact of high fees. Imagine two investors. Both invest $10,000 and earn identical 8% annual gross returns. Investor A uses a low-cost index fund with a 0.10% expense ratio. Investor B uses an actively managed fund charging 1.0%. After 30 years, Investor A ends up with roughly $99,000. Investor B, about $81,000. That's an $18,000 difference, from a fee gap of less than 1% per year. This isn't magic. It's math. Every dollar that goes to fees is a dollar that stops compounding for you. Keeping costs low is one of the most reliable ways to improve your long-term investment outcomes. Not all index funds track the same index, and that's actually a good thing. You've got options. S&P 500 index funds are the most popular. They track those 500 large U.S. companies. Total market index funds go even broader, capturing the entire U.S. stock market, including small and mid-sized companies. That's over 3,500 companies in one fund. International index funds give you exposure to markets in Europe, Asia, and emerging economies, adding global diversification to your portfolio. And bond index funds track the U.S. bond market, providing more stability and income. These tend to become more important as you approach retirement. Many financial experts suggest building a core portfolio with just 2 or 3 of these index fund types. You don't need dozens of investments to be well diversified. Here's an example of what a simple, diversified index fund portfolio might look like for a long-term investor in their 30s or 40s. This is for illustrative purposes only. Your ideal allocation depends on your age, risk tolerance, and financial goals. So consider speaking with a financial advisor about your specific situation. But the concept here is powerful. With just 3 or 4 low-cost index funds, you can own a stake in thousands of companies across the U.S. and global markets, plus some stability through bonds. This kind of broad diversification was nearly impossible for everyday investors just a few decades ago. Now, you can set it up in minutes through any major brokerage account. Alright, let's talk about where you actually buy these things. The best place to start is inside a tax-advantaged account. If your employer offers a 401k, check if they offer low-cost index funds. Many do. Your contributions may be pre-tax, meaning you reduce your taxable income today while investing for tomorrow. A Roth IRA is another excellent option. You contribute after-tax dollars, and your money grows completely tax-free. You can open a Roth IRA with brokers like Fidelity, Vanguard, or Charles Schwab, all of which offer excellent index fund options with very low expense ratios. Some of the most popular index funds, like Fidelity's FSROX Total Market Fund, have literally zero expense ratio. Always look for funds with expense ratios below 0.20% when possible. Here's a strategy that pairs perfectly with index funds. It's called dollar cost averaging. The idea is simple. Instead of trying to time the market and invest a lump sum at the perfect moment, you invest a fixed dollar amount on a regular schedule, say $200 every paycheck. When the market is down, your $200 buys more shares. When the market is up, it buys fewer. Over time, this smooths out your average purchase price and removes the emotional roller coaster of trying to predict market swings. Think about it this way. Very few professional investors consistently time the market correctly. Dollar cost averaging takes that pressure completely off the table. Set it, automate it, and let time do the heavy lifting. This is how ordinary Americans build extraordinary wealth. Let's make this real with some numbers. If you invested just $300 per month into a low-cost S&P 500 index fund, that's roughly the cost of a car payment or a few dinners out per week. And the fund returned the historical average of approximately 10% per year. After 30 years, you'd be looking at roughly $679,000, starting with nothing. That's the power of compound interest combined with consistent, low-cost index fund investing. Now, past performance does not guarantee future results, and actual returns will vary. But this illustrates the core principle. Time in the market, combined with low fees and consistent contributions, is one of the most powerful wealth-building tools available to everyday Americans. This is for educational purposes only. Even with a simple strategy like index fund investing, there are mistakes that can seriously hurt your returns. The biggest one? Panic selling. When the market drops 20% or 30%, and historically it does from time to time, the worst thing you can do is sell. You lock in those losses and miss the recovery. Second mistake, chasing performance. Just because a fund crushed it last year doesn't mean it will next year. The data consistently shows that last year's top performers frequently underperform going forward. Third, ignoring fees. Even a seemingly small difference in expense ratios adds up to massive amounts over decades, as we showed earlier. And finally, waiting for the perfect time. The best time to start investing is today. Waiting costs you compounding time you can never get back. Let's bring it all together. Index funds are investment vehicles that passively track a market index, like the S&P 500, giving you instant diversification across hundreds or thousands of companies at very low cost. Historically, they outperform the vast majority of actively managed funds over long time horizons, largely because of their lower fees and consistent market exposure. The best account to hold them in is a tax-advantaged account like a 401k or Roth IRA. Use dollar-cost averaging to invest consistently regardless of market conditions. Avoid emotional decisions during downturns. And most importantly, start. Even small, consistent investments in low-cost index funds have helped millions of Americans build real, lasting wealth. The strategy isn't glamorous, but the results speak for themselves. Build wealth with knowledge, not guesswork. Before you go, everything in this video is for educational purposes only and does not constitute financial advice. All investments carry risk, including the possible loss of principal. Past performance does not guarantee future results. Please consult a licensed financial advisor before making any investment decisions. Thank you for watching US Wealth Logic. And don't forget to subscribe for more content designed to help you build wealth with knowledge, not guesswork.